Welcome to Satya Skills. In this video, let us learn about rural insurance with special reference to crop insurance in India. India is a rural country. Even today, 70% of population lives in rural areas. Rural economic activities are agriculture, small and cottage industries, cattle rearing, handlooms, handicrafts, etc. But Indian insurance sector confined its business to educated employees, trade and business and industries, leaving this 70% of Indians. All the activities of rural sector are high risk activities. That is the reason leaving that 70% of Indian economy. Agriculture is still a gambling in India, therefore, the risk factor is very high in rural areas. The insurance needs of rural areas are like crop insurance, cattle insurance, etc. There are high potential areas for the development of insurance business in India. Important components of rural insurance. Rural sector is composed of different subsectors. They are based on primary and secondary economic activities of rural population. Accordingly, insurance schemes are designed in different ways. Agricultural insurance. Indian agriculture is producing a large variety of agricultural crops such as food grains, millets, pulses, fruits, vegetables, flowers, nuts, etc. They all are according to the climatic conditions. Specific features of Indian agriculture are: Indian agriculture depends to a large extent on monsoons and climatic conditions. Land holdings are very less. Majority engaged in agriculture are not highly educated. Natural calamities are very common and the victim is agriculture sector. Risk in agriculture sector. Frequent crop failure due to bad monsoons, price fluctuation in the market, uncertainty in getting output, plant diseases, and above all, no systematic maintenance of records either by the farmer or by the administrative authorities concerning that. Now, let us look into crop insurance. Crop insurance is the most important component of rural insurance. Due to high risk and uncertainty, insurance companies never approach the agriculture sector. Insurance companies require systematic records and land ownership titles, yield per hectare, etc. In a very clear terms, crop estimations are not available in recorded form. Scattered small land holdings was another problem that discouraged insurance companies to enter into Indian agriculture. To encourage the concept of insurance cover to protect farmers from risk of losses, the Government of India launched crop insurance scheme during 1985-86. The General Insurance Corporation was entrusted with the task of administering the scheme on behalf of the government. The insurance charges and claims in respect of crops insured in any state are shared between state and central governments. For this purpose, two funds were created: Central Crop Insurance Fund and Crop Insurance Fund by central and state governments respectively. For this purpose, the General Insurance Corporation maintains close contacts with the state governments, RBI, NABARD, state cooperative banks, RRBs and other such rural agencies. In 1985, the General Insurance Corporation introduced comprehensive crop insurance scheme to cover different crops in India. Later, it was changed into National Agricultural Insurance Scheme. Different ways of insurance cover. Crop insurance is based on different parameters. They are: on the basis of region, agricultural problems differ from one region to another, from one state to another. Within the state also they differ from one area to another. Thus, the insurance cover will be area based. Depending on a particular area, loss will be calculated. Farmers in the same region will receive the same compensation. Therefore, there is no individual claim in a particular area. This is important to remember. Second one, rainfall index to decide premium. The rainfall index is considered. Rainfall index of last 30 years is determined. Average of the week of the month in a year is taken for 30 years. If the rainfall is less than the index, payment is made proportionately. Along with rainfall, temperature, humidity, wind speed, etc. are also considered for different crops. Next one, fluctuations in the income. Price fluctuations is another risk factor in Indian agriculture. Even when climatic conditions are comfortable, crop output is normal, farmer may not get deserving price for his production. This results into a drastic fall in the income of the farmer. To give protection to this risk, the government introduced Farm Income Insurance Scheme during 2003 and 4. Individual farmers are also assessed for payment. That's all in this video. Next video, let us look into other components of agricultural insurance. All the